Welcome to the Compliance Officer's Playbook podcast. Okay, let's unpack this. We're dedicating this deep dive to a compliance failure that, well, it sent shockwaves across the global financial system.
It really did.
And sometimes the biggest risks aren't, the obvious cash smuggling or the classic money laundering schemes.
Right.
They're these incredibly complex, highly structured tax schemes that mask the true economic reality of who owns what and when.
Exactly.
You, our listener, shared these comprehensive reports on the massive fine against Morgan Stanley in the Netherlands, and it's a masterclass in why every compliance officer has to look beyond the clean paper trail.
That's absolutely right. Our mission today is really to focus on that Dutch public prosecutor's decision to pursue the maximum sanction. I mean, a staggering 101 million euros.
101 million.
And we need to analyze the sophisticated tax evasion mechanism they uncovered, but more importantly, we have to connect this one case to the broader compliance environment.
Right. The other threats you see in the sources.
From new crypto threats to, just foundational AML failures. The big theme here is understanding the difference between legal form and genuine economic substance.
Yeah.
Because when regulators find that gap, the consequences are, immediate and severe.
And the magnitude of that response is the real headline here. A 101 million euro fine from Dutch authorities.
Mm-hmm.
When you dig into the legal text, the sources confirm this is the maximum available sanction for a legal person under Dutch criminal law. They didn't just slap a penalty on them. They were making a statement.
It was definitely a statement. And the penalty was levied because two Morgan Stanley entities in the Netherlands were found to have enabled what the authorities just flat out called dividend tax evasion.
So this was systematic misuse of the rules.
Absolutely. This wasn't negligence. The findings, they really focused on an intentional structure, a design.
Okay, so let's break down that design, because this is where the sophistication comes in. It's not about hiding cash. It's about timing and derivatives.
It's all about timing.
The structure involved coordinated trading and derivatives activity designed to, temporarily place a Dutch subsidiary as the apparent recipient of dividends.
That's it.
And this is where it gets really interesting. The mechanism, it almost feels like what investigators call cum-ex or cum-cum schemes.
It has all the hallmarks. The entire scheme relied on creating the appearance of being a legitimate Dutch owner at the exact legal moment the dividend right crystallized.
The perfect moment.
The perfect moment. Investigators documented that the whole thing was a calculated sequence of share acquisitions timed right before the dividend payment date.
So the Dutch entity would briefly hold the legal title, get the dividend, and then, and this is the key part, claim the withholding tax offsets in its corporate filings.
Exactly. And this wasn't an isolated incident. The scale is, it's breathtaking.
The sources documented, over 800 million euros in dividends?
Over 800 million euros were channeled through that one Dutch subsidiary.
And that resulted in claims for more than 100 million in tax offsets.
Right. So for a compliance officer, that immediately raises a huge red flag. When you see such high volumes timed perfectly around dividend cycles, it just screams operational strategy, not, organic investment.
And that operational strategy was the fatal flaw.
It was the fatal flaw. The Fiscal Information and Investigation Service, the FIOD, which is the criminal investigation arm of the Dutch tax authorities, they didn't focus on the legal paper. They focused on the lack of economic reality.
So the Dutch entity was basically a temporary holder by design.
By design. It was acting like a temporary mailbox for the dividend. It carried no genuine investment risk, no long-term ownership.
Okay, so if I'm a compliance officer looking at this, my question is, how do I prove that? How do I prove it didn't carry risk? What was the definitive proof that the filings didn't match the reality?
The proof was in the prearranged flow of money. See, if the Dutch subsidiary had been the genuine owner, it would have held the market exposure.
Meaning if the stock price tanked, they'd take the hit.
They'd take the loss. Exactly. But in this case, the risk was transferred away at the same time. If you're loving this conversation and want to be part of keeping it going, the best way to support the show is to become a paid subscriber on Apple Podcasts. You'll get access to the full episode, plus every deep dive we do. Head to Apple Podcasts, search Compliance Officer's Playbook, and join our growing community today. Invite listeners who love this show to become a paid subscriber today for $5 USD, and get full access to all premium episodes packed with insights, stories, and value they won't find anywhere else. Thank you for joining us on the deep dive.